First educational video. I'll be making a series of these which is going to break down in kind of the simplest terms possible the way I see the markets and how you can quickly and easily determine a daily and weekly bias using the weekly open high low close, the daily open high low close, and the 4-hour open high low close. In this video though, I'm just going to run through the monthly, weekly and daily chart and just kind of show you how I sit down at the start of the week and the start of the day, and often the start of the month, and what I'm looking for and how I'm kind of trying to determine my DOL and my drawn liquidity. So we always start with the monthly. Now the monthly chart I will normally just tend to reference at the start of every month. Sometimes I'll reference it in the middle of each month as well, kind of depending on where price is going and what we've done, but it should be really simple and easy kind of exercise to do when you're looking at your monthly and weekly. It should be quite obvious on kind of like what you're seeing. So before we do anything, we always start with a range. Now I'm not going to talk about dealing ranges in this video, but as most of you know, you will be very familiar with premium and discount ranges. So before you sit down on any chart, determine the most recent range. So a range where the highs have been taken and the lows have been taken. This is the simple range on the monthly, this high to this low, where you can see the highs were taken here and then the lows were taken here. So we've got this now. Price, this is the parent range until price breaks out either the low or the high. So at the moment we can see that price moved into a premium and then now moved down into a discount. So what we actually see on here, and again this is the monthly chart, but we saw a liquidity raid inside the premium, and then price moved down to discount. So as price moved down to the discount, it ran into this inefficiency here, this fair value gap. So the way that I'm now seeing price is it's come up into a premium and it came down into a discount. Now price broke a high and it ran a low. So now inside of this range we've got a fractal bearish range here. So inside this range we've got a 50% and we have this fair value gap here, which I'm actually just going to mark on as with a line at this high. So, and I'm going to get rid of this range for now. So in simple terms, we've moved down into a discount and we now need to move back up. So we've taken this liquidity, I'm going to move back into this liquidity, which is the internal of this range. So we can see it, this consolidation external and then back into the consolidation for internal. And then I won't talk about it too much, but we've also got this range here. So price came into the discount of this range. It's now going to move back into the premium. But all we need to know is price has hit this inefficiency and it's now going to move up to this, which is the most logical area for price to run into. So if we go to the weekly, which is a kind of x-ray of our monthly, we've got let me just make sure that that shows up on, oops, that's not right. Okay, so the blue box is our monthly fair value gap, and you can see that inside at 50% of the fair value gap there was this low. The price came and ran this low, so I'm now going to get rid of this box so our chart's nice and tidy. So this is the low, and let me just make sure that that is going to show up on our monthly high. There we go. So okay, so we've got the low and we're expecting it to run into this monthly high. So the weekly is where we want to find our weekly open low high close, or the open high low close. And in case you don't know what I mean by that, every candle has an open, it has a low, it has a high and a close, and the low and the high are often the wicks. So every time a new candle opens, for example this current weekly candle here is open and it's pushed down. Now because we're bullish, as I explained previously on the monthly, we can look on this weekly chart and we can draw another range here. Look, so we've got price ran a high and prices ran a low, so we've got this premium discount range here. So we're currently in a discount, and with the monthly narrative we know that we've come to this low and we're going to move up, so we're expecting bullish weekly candles. So a bullish weekly candle will open, have a low, and then it'll have a high and then a close. So it will end up looking at something like this. Oops. So currently we could end up looking something like this. So currently this is going to be the wick. So the open, low, and then high close. So this here will end up looking that's not working. There we go. So we're looking for this candle, this currently to be the wick, and then move up, because we want, what we want on the weekly is the move up to this monthly high. Now it's irrelevant how many weekly candles we think. I mean, it could do it in this one weekly candle if we had a lot of high impact news, but it could do it in two, it could take 3 or 4, but all we're looking for is every new weekly candle to be an open, low, high close. So like this one, open, low, high, close. So this current weekly candle, we're expecting it to move back above its open. Once it's found its bottom, its base, and where it's going to bounce. So determine that, we go to the daily. Get rid of that because I'm going to show you this in a sec. In fact, let me just get rid of all these lines so we're not getting confused. So daily, we've got the weekly open. Price is currently moved down, so I'm expecting this to be the wick. So this, I'm expecting it to be this, similar to this, the wick down. So we need to find excuse me, we need to find the level where it's going to come down. Now we use our weekly template for this. So the classic Tuesday, Wednesday, Thursday low, midweek reversal. Sometimes we can just head straight up on a Monday, but as you know, we're likely to reverse on a Tuesday, Wednesday or Thursday. So the way we determine that is we can look at our daily or our 4-hour chart. So on this daily chart, we've got this low here, which is a fair value gap. So we could expect price to come here and move up. And that would be, you know, that could happen today, which is Tuesday. It could happen tomorrow, Wednesday or Thursday. We go to our 4-hour. We have got, this is that low here. This is that daily low. So we could come down here and then reverse and come up. So this could be a Tuesday low, Wednesday low. And then head back up to last week's high. Because, sorry, something I forgot to mention is every time we see a new candle and it's bullish, we want it to break the high of the previous candle. So if this is to come down and create a wick, we want it to break above its open and also above the previous weekly high. So back to our 4-hour. So that weekly high is here, basically. So we're looking for an area that's going to reverse and then move up. Now I'm not going to go into the lower time frames in this video and these smaller ranges, but I'm going to talk about the ICT 20, 40, 60-day look back in a second. But I just want to point out that, and again I'll go into this in another video, but every time we see price on the right, we want to reference the price on the left. So anytime there was selling on the left, we want to match it with buying on the right. So every time we have a high and price breaks it, you'll normally find there's an order block, a bullish. When we break a high on the left, you'll often see there's a bullish order block that forms at the high. Now when I'm forming out my highs, I like to mark the bodies, not the wicks. So for now I'm just going to quickly show you this, and I'll go into this in another video. But so these are the highs in previous price action. You can see that every time price broke the high, created an order block. Price came into the order block and leaves here. Price broke the high, created an order block. Price came into this order block, moved up. Here, price has come up, created an order block. Price has moved up. So we've got two scenarios here. The most likely is that price is going to react from this point here and move up, or it's going to run this low and move up. But that's for another video. All I wanted to show you now was how to determine your high time frame bias. Let me move these. Now, unlike a lot of the other YouTube gurus, I try not to make things too complicated. I'm not going to go into too much detail about stuff. I'm just trying to kind of show you a quick, simple way to find bias, and you know, just the way I trade. As someone who trades all the time, not trying to sell courses or anything, just genuinely trying to help people out. This is how I determine price. So again, this monthly high, I'm going to get rid of that as well. This monthly high from the monthly chart. Weekly, we determined that it's this high here, so we're looking for bullish candles. And then on the daily and the 4 hours, where we're looking for our turning points on the week. But now if we turn on my ICT look back, so the algorithm has to reference a past range. It's the only thing price can go on it, but price just doesn't move in kind of space. It has to always reference the left hand side of the price. And one of the best things you can do is mark the 20-day, 40-day and 60-day look back. So if this is the 60, this is the 40, and this is the 20. So I'm going to get rid of this now. So 20 days, 40 days, 60 days. So this here, which if you've noticed is our DOL from the weekly chart, this is our 60-day high. We've got our 20-day high here. So this is the highest high in the past 20 days. You can see that the 40-day highs were ran, but this is the highest high in the last 60 days. All of the lows have been ran. So we've got this low was ran in 60 days. These lows were ran in the 40 days. And this is our current 20 days. So the highs that have been left open are the 60-day high, because the 60-day low has been taken. So this is our main DOL, and this is our current DOL. So these highs have yet to be swept. So there's liquidity resting above these highs. And this high, is our weekly high. So this is our DOL. So this is what we're basically heading up. If you do this all the time, if you're struggling to find liquidity on the high time frames, just run the 20, 40, 60 days, because it should give you a real nice idea on where there is pending liquidity is sitting. So this is why I'm bullish on euro. And obviously we can check the dollar index, pound, there's SMTs and all stuff like that, but that's all to do with the lower time frame, which I'm not showing in this video. I'm just trying to show you how to determine that higher time frame bias, because once you've got this higher time frame bias, you can stick to it, and you don't. I'm going to change that to 60-day high. Basically you stick to it and you don't let price change your mind. 20-day high. So now you can see clearly where the liquidity is. And remember, if this is the larger range, which is the only valid range, because we're currently inside this range, we're in a discount, so we need to move up to a premium. So you can see logically this is the liquidity, and that's basically just how I determine my liquidity for the week, for the month. And then I'm just simply waiting for weekly candles to form and give me the open, low, high, close up to these areas. Okay, I'll leave it here for this video, and I will see you in the next one.